Is Singapore Airlines actually a good dividend stock in 2025? SIA just released its half-year results for the period ended 30th September 2025, and, well, the numbers paint a very mixed picture. Strong operating profit, weak net profit, and a dividend plan that looks generous, but also carries real risks. At $6.48, as of 27th of November 2025, is SIA undervalued, fairly priced, or overpriced? Is the dividend really sustainable, especially with Air India dragging down profits? And with Fed rate cuts potentially coming in 2026, will SIA benefit, or could it actually get hurt? Stay till the end, because today's video breaks down everything Singapore income investors must know before deciding whether SIA deserves a place in your Kopi Money portfolio. If this helps you, like this video so more Singaporeans can watch it, and subscribe to Wealth for You for more Singapore-focused dividend insights. This is not financial advice. Please do your own due diligence. Chapter 1. What is dividend investing? Alright, before we jump into Singapore Airlines, let's make sure everyone is on the same page. Dividend investing means buying companies that pay you part of their profits regularly. This creates passive income, your Kopi money, your grocery money, even your weekend durian money. But dividend investing works best with steady profits, strong free cash flow, and predictable payouts. Airlines, however, are one of the most cyclical sectors in the world. So the question becomes, can SIA behave like a dependable dividend stock? Let's find out. Chapter 2. What exactly is SIA's business? When we think of SIA, most of us picture the iconic Singapore girl and a premium full-service airline. But the truth is, SIA is a much bigger ecosystem than just one airline. The SIA group operates like a multi-engine aviation machine. You have Singapore Airlines, the flagship full-service carrier. You have Scoot, its low-cost arm capturing the budget travel crowd. There's also a significant cargo business, moving goods around the world, especially on long-haul routes. And on top of that, SIA holds a 25.1% strategic stake in Air India, which adds both long-term potential and short-term financial drag. Revenue flows in from multiple streams, from passenger travel, from cargo shipping, and from a growing suite of ancillary businesses: Chris Flyer, Chris Shop, Chris Plus, Pelago, and the whole loyalty ecosystem. But with all these engines humming, SIA still flies in one of the most unpredictable industries in the world. Its earnings swing with oil prices, the strength of global travel demand, USD movements, and geopolitical tensions that can reshape entire flight paths overnight. Competition is fierce too, especially from the Middle Eastern giants and fast-rising Chinese carriers. All of this means one thing. SIA's earnings and dividends naturally move up and down far more than steady sectors like REITs or banks. Chapter 3. SIA Half-Year Results, April to September 2025. Released on 14th of November 2025, SIA's half-year results show strong demand but weaker profitability. Revenue rose 1.9% to 9.675 billion Singapore dollars as SIA carried 20.8 million passengers, up 8% with an excellent 87.7% load factor. But despite fuller planes, passenger yields fell 2.9%, squeezed by tough competition, and cargo revenue dropped 2.8% as global trade softened. Demand is strong, but SIA is earning less per seat. Even so, the airline delivered a steady operating performance, with operating profit inching up 0.9% to 803 million Singapore dollars, showing the core business remains disciplined. The bottom line, however, tells a different story. Net profit plunged 67.8% to 239 million Singapore dollars, hit by lower interest income and weaker contributions from associates, and most significantly, by massive losses from Air India. With SIA now equity accounting its 25.1% stake, those losses flow directly into its books, making Air India the biggest drag on Singapore Airlines' profitability today. Chapter 4. Is SIA overpriced or undervalued? At $6.48 as of 27th of November 2025, SIA actually looks reasonably priced for what it offers. The airline sits at around 20.4 billion Singapore dollars in market cap, reflecting its scale as a global premium carrier. Its net asset value per share is $4.97, giving a price-to-book of 1.3 times, which is, a fair premium for a strong national airline. On earnings, the valuation looks even more attractive. A price-to-earnings ratio of 8.9 times makes SIA not expensive at all, and honestly, even slightly cheap compared to other full-service international airlines. However, return on equity sits at roughly 5%, and that's dragged down heavily by losses from Air India. Without that associate drag, profitability would look much stronger. Where SIA really stands out is its balance sheet. Using the MAS REIT-style metric, SIA's debt-to-assets ratio is just 26.7%, far below the 50% gearing cap. For such a capital-intensive business, that's very conservative leverage. So what's the verdict? At $6.48, SIA is not overpriced. Its low price-to-earnings, reasonable price-to-book, and strong balance sheet point to a stock that is fairly valued to slightly undervalued. The only thing stopping SIA from being cheap is the ongoing Air India losses, which continue to weigh on the bottom line. Chapter 5. Dividend Yield and Sustainability. SIA's dividends have been, surprisingly generous. In the past 12 months alone, shareholders received 38 cents per share. That's a 30-cent payout on 27th August 2025, plus 5 cents in interim dividends and 3 cents in special interim dividends. At $6.48, that works out to a trailing yield of 5.86%, which is unusually strong for a cyclical airline. Looking forward, SIA has committed to a 10-cent special dividend every year for the next 3 years. For financial year 2025-26, investors can expect 5 cents interim dividend, 3 cents interim special dividend, 10 cents annual special dividend, and a final ordinary dividend, likely between 5 and 10 cents. This puts SIA's forward yield at roughly 3.54 to 4.32%, lower than last year's bumper payout, but still respectable for a national carrier operating in a tough industry. For dividend chasers, the next key dates are clear. SIA goes ex-dividend on 5th of December 2025, with payouts made on 23rd of December 2025, covering the 5-cent ordinary and 3-cent special dividends. So, is the dividend sustainable? The 10-cent annual special dividend is secure, backed by a formal capital return plan. But the ordinary dividends are far less predictable, influenced by yield pressure, associate losses, competitive intensity, and operating costs. In short, SIA's dividends are best treated as bonus payouts, not stable COPI money you can depend on every year. Chapter 6. Future Prospects and Risks. SIA's outlook is a mix of strong tailwinds and equally real challenges. On the upside, travel demand remains robust, and SIA is rolling out new fuel-efficient aircraft that should lower costs over time. Its expanding KrisFlyer ecosystem, from KrisShop to Kris Plus and Pelago, is building a loyal, high-value customer base. The multi-hub strategy with India offers meaningful long-term growth, and a strengthened balance sheet gives SIA room to pursue opportunities and absorb shocks. But the risks move just as fast. Air India continues to bleed, dragging down profits. Competition from Middle Eastern and Chinese carriers is rising, putting pressure on yields. Fuel prices remain volatile, and the cargo slowdown removes a key buffer. And ultimately, SIA operates in a cyclical, unpredictable industry, with high capital expenditure that can tighten returns in weaker years. In short, SIA has real potential, but income investors must accept that its risks rise and fall just as quickly as its opportunities. Chapter 7. How Fed rate cuts in 2026 impact SIA. If the Fed starts cutting rates in 2026, the effects on SIA could be felt almost immediately. On the positive side, cheaper borrowing costs lighten SIA's financing load, and a stronger global economy boosts travel demand. A weaker US dollar would also lower SIA's major expenses, from aircraft payments to fuel, improving margins and helping support its dividend plans. But there are risks. Rate cuts can push oil prices higher, making jet fuel more expensive. And if the cuts happen because the economy is slowing, travel demand could fall instead. In short, Fed rate cuts are slightly positive for SIA, but only if they come with a soft landing, not a recession warning. Chapter 8. Is SIA worth owning for dividend investors? SIA can be part of a dividend investor's portfolio, but only with the right expectations. This is a counter you approach with care, not one you rely on for steady copy money. It works best for investors who are comfortable with volatility, who enjoy occasional bonus dividends, and who believe in the long-term growth of Asian travel. These are the investors who can ride out SIA's ups and downs while still appreciating its upside. But it's less suitable for those who need predictable income, are building a 12-month dividend wheel, or prefer the stability of DBS or REITs, such as CICT, or REIT ETF, such as CFA, where cash flow is steady and payouts are more reliable. So the honest conclusion is this. Treat SIA as a satellite holding, not the centerpiece of your dividend strategy. It can add flavor and upside, but it shouldn't be the foundation of your copy money portfolio. Final thoughts. So, is SIA a good dividend stock in 2025? The honest answer is this. Good for upside and special dividends. Not great for stability. SIA's core business is strong, but net profit volatility, yield pressure, and the ongoing Air India drag mean the dividends are more bonus than copy money. It can play a role in a diversified income portfolio, just not at the center of it. If this breakdown helped you understand SIA's results, valuation, dividend outlook, and risks, like this video so more Singaporeans can learn, and subscribe to Wealth for You for more Singapore-focused dividend insights. And let me know in the comments, do you think SIA is worth owning for dividends, or is the risk too high? This is Wealth for You, helping Singaporeans build a cash flow-rich retirement, copy money included.